To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jalinski, the financial quarterback. Don't touch that dial. Let's talk about some tax reduction strategies that you teach small business owners.
Sure. I think the first thing you need to understand is that the tax code is merely a recipe book. So if you understand that to be the case, your goal should be figuring out what recipes you want to take advantage of and then learning how to put them together in the right order, right? So if you look at the tax code as a whole, and the latest iteration, including like all of the supporting material that's provided through regulation and by the IRS, it's about 17,000 pages long, and about 70% of that tax code is oriented towards business owners and real estate. And when you read the tax code and you understand how they deal with real estate, they actually deal with it as if it is a business. So if you are investing in real estate or you are a traditional business owner, about 70% of the tax code is written really with you in mind. So the goal is for you to understand how to actually apply that to your life. I teach essentially lots of different tax strategies, but I often start with a core foundational 5. And the reason I do that is because most of the time, tax strategies are just layering upon one another. Meaning, like if you put into practice one particular aspect of the tax code, you'll likely be able to benefit from another aspect when you layer them the correct way. But before you can even do that, it's important to actually structure your businesses the right way. What I mean by that is, if you think about it, the vast majority of businesses have no structure at all. They operate as sole proprietorships, which essentially is just an individual going out into the marketplace and trading their time, effort, and energy in the production of goods and or services to the public for money. But the challenge with operating as a sole proprietorship is that you tend to, one, have the least benefits when it comes to taxes for business owners, and two, you substantially open yourself up to major challenges when it comes to liability and liability protections. The other thing that a lot of people don't recognize is that when you are operating as a sole proprietor, when you're accounting for that from a compliance standpoint, and when I say compliance, I'm talking about tax preparation, because that's what tax preparation is. It's complying with the tax laws. So the compliance activity that a sole proprietor engages in is essentially taking all of that business activity and funneling it directly to their individual tax return, their 1040. And that happens through a specific schedule on the tax return called a Schedule C. What most people don't recognize is that if you look at the entirety of the IRS, the vast majority of professionals that are on their audit teams are skilled in dealing with matters related to the 1040. Meaning that's their area of specialty. And a Schedule C is a matter related to the 1040. And if you look at the amount of audits that take place for business owners, everyone has a different statistic that they point to. But in general, you can think about the fact that you have up to a likelihood of about a 4% environment where you'd be audited, meaning 4% of all Schedule Cs that get filed are earmarked, if you will, for a little bit more scrutiny from the IRS. Simply reorganizing yourself in an actual different way from a structure standpoint can lower your audit risk. As an example, if you have elected S corporation tax treatment, for instance, through an LLC, your audit risks are less than 0.4%. So you dramatically reduce it. Why? Not because you're doing anything remarkably different. There are fewer professionals at the IRS that have a skill set that would focus on a more advanced structure in business. And therefore, since there's less people to deal with those structures, the possibility of audit tends to go down. The probability of, I should say, of audit tends to go down. That doesn't mean if you're doing something really bad that you won't get flagged for an audit. It just means that if you're doing things the right way and you're comparing apples to apples with regard to a Schedule C filer versus a filer with a more advanced business structure and business entity in place, the one with the more advanced business structure and entity would tend to have a lower probability of being audited. So the first and foremost thing that I try to teach business owners is put the right structures in place. I have a whole matrix that I teach with regard to the ownership of assets. I refer to it as hierarchy of ownership. The way I start with is at the top of the hierarchy, I utilize trusts, specifically revocable trusts for the most part. There is something to be said about utilizing irrevocable trust, but not for the majority of people. So I tend to suggest that they consider revocable trust to own everything in their life. On the personal side, having the trust own your personal assets, like your personal bank accounts, your personal residences, your automobiles, your boats, etc. But also to have trust own your business assets. And in the next hierarchy of ownership down, that first business structure that I tend to suggest people consider is something I refer to from a term of art standpoint as a holding company. It's simply a business that is, the purpose of the business is to own other businesses. And the structure I tend to utilize there is an LLC, a limited liability company. And typically that is where I'm also electing something referred to as S Corp tax treatment. So the limited liability company is probably the most popular entity form that exists in the United States right now. But most people think that that is like a business from a tax standpoint as well. But the nature of a limited liability company is simply the legal structure around the business that has nothing to do with taxes. So if you don't tell the IRS how you want to be treated as a tax entity, the IRS will actually consider that LLC to be disregarded for tax purposes. And it will essentially look at it as if the LLC isn't even there. And they'll look right through that entity, and all of the income and expenses associated with that entity will flow through to you as an individual, again, finding its way to a Schedule C. But if you elect S corporation tax treatment, that's where the IRS then will see the entity for tax purposes. You'll file a different tax return for that entity. It's called an 1120S, which is a business tax return, specifically for S corporation entities, or entities being treated as S corporations. And when you do that as a business owner, you immediately get to reduce your exposure to something called self-employment tax. So a lot of people are pretty generally familiar with income taxation, right? So as a business owner, you earn income, you net out all of your expenses, and you're left with a taxable income amount. And that's what you're taxed on from an income tax standpoint. But what a lot of business owners don't recognize, or at least realize in the beginning, is that you're also subject to something called self-employment tax, which is an additional tax over and above your income tax. And right now that's taxed at 15.3%. And that's comprised of two types of taxes. It's comprised of Social Security tax and Medicare tax. Social Security is at 12.4 and Medicare is at 2.9. So together, that's an additional 15.3%. So let's do some basic math for people to just help put this into context. Let's assume that you own a business, you're a business owner, and you are either a Schedule C filer, so a sole proprietor, or you're a single member LLC that is disregarded. So it has not elected any type of S corporation tax treatment. It's just a disregarded entity, which would then mean you would be also a Schedule C filer as well. If that were the case and you earned an amount of money that after all of the business expenses, you were, before taxes, your taxable income amount was $100,000. Besides your income tax, you would owe an additional $15,300 of self-employment tax. And again, that's 15.3% of $100,000 would be $15,300. If you just, instead of doing that, you had S corporation tax treatment, what an S corporation requires you to do is to take something called a reasonable salary based on the taxable income that you generate. And a reasonable salary is up for interpretation, but for like simplicity's sake, let's just assume that you went with a 50% reasonable salary. So in the same scenario, you have $100,000 of taxable income. You take 50% of that as a reasonable salary. That's $50,000. In the context of an S corporation, that $50,000 reasonable salary, that would be the amount of money you would pay your self-employment tax on. So instead of $15,300, your self-employment tax would be $7,650. The remaining $50,000 under the S corporation is going to be considered a dividend to you as the business owner, not earned income, not self-employment income. So it completely escapes self-employment tax, which would save you, put in the pocket savings for that business owner, $7,650, right? So, and the only thing you did differently was file a different type of return. You'd have a different type of entity structure around your business. And that simple change, you can operate your business in every other regard the same way. It's just you're treating your business differently for tax purposes. And that's an example of a tax reduction strategy that could be implemented. Now, there are some practical limitations, right? Because in order to do that, you're talking now about a business tax return, which means you're typically going to involve an outside professional to assist in the tax preparation. So there's some expenses and costs with doing that. There are some expenses and costs with regard to establishing the legal structure and then to comply with the ongoing filing of annual reports with the state where that legal structure is created. So there is cost to doing this. And the way I tend to share this with business owners is that if you are in an environment where you have at least $40,000 of taxable income, I'm not talking about the total amount of income you earn, I'm talking about the amount that's taxable. So after all of your expenses, et cetera, if you have about $40,000 of taxable income, the S corporation tax strategy almost always works from a math standpoint. The maths, right? At the end of the day, your savings outpaces your cost for setup and maintenance of that particular entity. So that's an example of a strategy that I'm almost always going to utilize, and it's right at that middle hierarchy of ownership in what I refer to as the real wealth matrix, because my trust would own the holding company. The holding company is where I'm electing S corporation tax treatment, and therefore that's where I'm saving, at least potentially, a reasonable amount of money from a self-employment tax perspective. I still have income taxes that I have to contend with, and there are other strategies to deal with that, but I'm saving on the self-employment side of the spectrum, which is a good way to start that savings discussion. And then below the holding companies are where operational companies exist for me. And again, that's a term of art. I'm just talking about a business entity that is set up for the purpose of engaging in commerce with the public, right? The purchase or sale of goods and services. That happens at an operating company level. I also tend to recommend that be an LLC, a limited liability company, but that is where I want it to be a disregarded entity. I don't want there to be any tax treatment there because I want all of the income and expenses to flow up to the holding company, which is where the tax return gets filed. And then you could have like multiple businesses. Like for instance, in my case, I own multiple businesses that are at the operating company level. All of them are single member LLCs owned by the holding company above it. So I don't file tax returns at any of this level at the operating company level. I file the tax return at the holding company level, which helps to minimize the cost of compliance, right? Because I'm not filing multiple tax returns. I'm filing a tax return only at the holding company level. So that's an example of how you use structure to be able to take advantage of a tax strategy.